The next session, we are going to be going over what is the reserve currency of the new internet. And we are joined with some absolute chads from the space to talk about what DeFi 3.0 looks like. As I kind of mentioned from the last session, let's feel free to be interacting with each other, ask questions, don't be shy. Let's work on these solutions together.
Okay, yeah, I mean, question is that. We'll see based on your guys' answers where we go with this conversation. But I think first question, you guys have both launched stablecoins or may launch stablecoins. What I think that is the core question. What is the reserve currency of the internet? Is it Bitcoin? Is it ETH? Is it stables? Is it something else entirely? Let's start there, and we'll see if there's any spicy takes to start.
Yeah, I mean, it's an interesting question. I would say the world reserve currency is still definitely the US dollar. Maybe that changes one day, but as of right now, that's still the case. And for on-chain, I don't really view it as like a different thing. Like, I think it's like this continual convergence between TradFi, DeFi. All these things are just going to eventually become finance. And so we're already seeing that stablecoins are one of the most popular use cases in crypto. And it's for good reason, like for the reason that the US dollar is the world reserve currency. So yeah, I think that's definitely the case.
Also, forgot to do intros. Can you guys just quickly introduce yourselves, protocols, and what it does?
Sure. So I'm Sam, CEO of Phoenix Labs. We work on Spark. So Spark was launched in May of 2023. Sparkland, our first product, is a lending market. It's a fork of Aave, but it is the key differentiator is that it is connected to, at the time, DAI. It's now been since rebranded to USDS. It's got this direct liquidity injection from Sky Protocol. And because of Sky's massive size, 5.3 billion in deposits as the largest decentralized stablecoin, it's able to enforce liquidity. So our user base is largely larger users who want to borrow like 200 million at a time. And in the wider DeFi space, this sort of size will like spike the rates, and you kind of have this uncertainty with LPs who are going to come in and provide more liquidity. It's been getting better, but having that sort of strong confidence and guarantees that Sky, formerly Maker, has been a very strong value prop, and as we are the second largest lending market in DeFi. But more recently, we've been switching more to B2B style liquidity provisioning across all of DeFi. So less about running our own internal products and more about just lending to the lending markets that people already love to use. So Aave, perfect example. Like we will just lend USDS or USDC, and eventually we'll support Tether as well. We'll just lend stablecoins across all of DeFi so that users can use their favorite lending market, and they don't even have to really think about it anymore. We'll be the LP side across all of DeFi, and because of the large size, we have about 3 billion sitting in stablecoins and T-bills. We can enforce much better rates, much more stable rates across DeFi, which we're very excited about. We'll be rolling this out in the coming months.
Mr. Barra?
Very cool. Sorry, guys, I've lost my voice a little bit, so, bear with me, no pun intended. Smokey from Barachain over here. This may be self-explanatory from the Bear Mask, among other things. A little bit of context. Barachain is an EVM identical L1 built using BeaconKit, which is our implementation of EVM. More than anything, I think people know Barachain for general stupidity in many cases, but beyond this, something that we call proof of liquidity, which is really meant to align incentives between liquidity and security at the chain level, and use that to actually help power the applications built on top of the chain. The real high level there is that I think having observed the Alt-L1 ecosystem and generally the growth of chains over the last little while, it became incredibly clear that even with the advent of liquid staking, EigenLayer, a number of these solutions which allow for forms of security to also be converted in some manner into liquidity, they're very much opt-in. They're by no means baked into the base layer. And rather, there's a way that we could take these chains that are currently, paying, let's say, $500 million or $250 million of security incentives to secure, half of that or less in liquidity on the chain, and actually turn that liquidity, which is productive on the network, into a source of security for the whole chain itself. I think beyond this, we've moreover seen that most chains really do not offer anything to their applications in terms of actually, I'd say, a mechanistic financial advantage, if you will. One does not stand to necessarily gain more from an actual, I'd say, liquidity access, user acquisition costs, customer acquisition costs, capital efficiency by being on chain A versus chain B. And our thesis is that Berachain really should be driving value towards those groups that should be really helping the ecosystem grow and proliferate more than anything else, with a real focus on applications and users. So what that means is that whenever a block is built on Berachain, that block reward is actually being injected into the ecosystem and into applications that are actually living and breathing on the chain, as determined by the validator that proposes that block. So the goal there is to really help applications go from 0 to 1, and in the perfect world, sort of cross that chasm of death as they reach escape velocity or that breakout point, and hope to see the next massive Uniswap moment or Spark moment for that matter on Berachain.
And reserve currency of the internet?
4chan? I don't know. I think that right now, Bitcoin might be the closest thing that we have to that. I think that there is still a jury to be decided on ETH, Solana, a number of other things. Funnily enough, like the question makes me think back to the kind of cursed DeFi 2.0 summer days and the fun and insanity that was Olympus, because that was the whole initial pitch, right? It's okay, we'll become the reserve currency of the internet, or of crypto, I should say. The problem was that the whole concept of bonding all these different assets into the Ohm token and having that as an underlying backing, which then traded at some much beyond MicroStrategy style multiple on the net asset value. Was not too great because 95% of those assets were ETH correlated. So, when one part of the market tanked, a lot of parts of that market tanked. And that anti-fragility was really not what was given to the protocol as they expanded. I do believe that there's a world where if one was to find enough decorrelated sources, you could actually build something a little bit more interesting there. But I think it's also very tough to find truly decorrelated sources in crypto. The market does follow Bitcoin and ETH, and I'm sure that things may evolve over time, especially with pending regulation and the new regime they're about to enter. But I think we're still relatively far from that. Like maybe there's something around spicy RWAs, compute, yada yada yada, but really that's not necessarily the internet. That's just taking stuff that's off chain and bringing it on chain and I'd say twisting it a little bit, right? So I'd say the closest thing in my mind right now is Bitcoin.
All right, and you brought up a point that's interesting. I mean, Maker started as basically exactly that, like CDP for assets. Do you want to, I don't know that everybody even knows what that means or how that works. Like, do you want to just walk through how Maker works? And then I want to walk through how like proof of liquidity and how Berachain works. So you want to whiteboard and just walk through it?
Oh man, I'm so bad at this. Yeah, okay. Can I just describe it, or do you want me to whiteboard?
Do you guys want him to whiteboard?
How do I do this?
Just the marker right here. This one.
Okay. All right, so you have, I guess this is Maker, the original DAI. Actually, even before DAI, there was a single collateral DAI, which was ETH only. But when multi-collateral DAI launched in, when was that? November of 2019 was the original launch. Yeah, you would lock up your ETH. You stick it in a, I don't know, a vault. And then with this collateral, you now have some amount of borrowing power that you can mint the DAI stablecoin with. So yeah, so then out comes the DAI stablecoin. Yeah, forgot the old logo. Okay, so yeah, as long as you maintain your position such that this is, say, over $150 worth of collateral, You can mint, say, if the collateralization ratio is 150%, then you can mint up to $100 worth of DAI, and this is the over-collateralized nature of DAI. So this is the original way that DAI was made. But quickly, there was run into the problem where below peg, you have actually to keep something at $1, you have to use these levers because it's a very artificial thing. So there are two scenarios that happen with this with the peg. So if you have peg breaking down, so DAI is suddenly worth trading at 99 cents. You have mechanisms to bring it back in line. Because of the over-collateralized nature of the stablecoin, there is always a point where you can raise interest rates to get people to buy DAI on the market to repay their loans. And so there is always some point that you can do this. So what you do is you bring the rates up and up and up until people rebuy the DAI on the market. It will bring the price back up to $1, and then it's good. The problem is if you have it break up, you are reliant on more people to take leverage, but there's a limit. You can only set the interest rates to 0 before you have to start imposing some sort of complex negative interest rate system. You can do that, and this is actually what RAI is, but to keep it at $1 from the breaking up, it was quickly realized that in order to scale the system up, USDC was needed to be introduced as this collateral asset that you can add with high leverage. I don't know how detailed we want to get into this. So USDC was added in, when was that? March 2020, I think? Yes, in response to the Black Thursday event where ETH price dropped due to COVID by about 50% in like one day. It was a huge amount. People were panicking. The protocol actually almost collapsed on that day. There was a governance vote to determine whether to just shut everything down, but it narrowly avoided that because there was like this huge hole in the balance sheet due to some exploiters thing. Anyways, after having launched in November of 2019, having this sort of catastrophic event happen 4 months in was pretty crazy, and it definitely put Maker through the ringer at the time. Anyways, as a response to that, the amount of people who were taking loans suddenly dropped way below because people no longer wanted to take leverage because the market was crashing. But a lot of people wanted to hold DAI and go into a safe haven. This means the price went above $1, and so thus we had to introduce USDC, whatever the logo is for USDC, as a high leverage vault so that there's an arbitrage where people can short DAI with USDC in order to bring the price back down to $1. Trade-off is you now have a centralized collateral backing your stablecoin, but the unfortunate reality is this is necessary. All stablecoins that want to scale up beyond, I think you've seen some at about the order of 100 million-ish, but that seems to be about the limit of where you can go without introducing centralized stablecoin backing. So this is just the unfortunate nature of reality and finance.
That's a function of liquidity purely, right? Like, is that why they can only scale to 100 million?
It's not like a hard limit or anything, but the reason is because in order to scale up beyond that, you need the demand for leverage or some other use case. But for now, mostly the use case of stablecoins on the borrow side is people are levering up, BTC USD or ETH USD in one form or another. And so you need the amount of people who are taking leverage to somehow magically be the same as the people who want to hold stablecoins if you were to do this like more pure ETH system. But there's no fundamental reason that should be the case. Like, why should that be the case? So it just turns out that there's more demand for holding stablecoins, using them as payments, than there is for people who want to take crypto leverage. So yeah, that's why there's that limit. Yeah. This is enough.
Right. Yeah, I think this is good. Okay, so DAI in a picture. This is kind of the original structure, one of the oldest school primitives of DeFi. Smokey, I think I'm supposed to be your scribe
Yeah, man.
here.
I'm not gonna lie, guys. The visibility in this thing not ideal.
All right, let's talk about. where
Generally
we've
illiterate.
gone.
Alrighty. So this will actually be a good test of like how well I can explain this shit without confusing people. Okay, so perhaps the most important first thing to know about Berachain is that there's actually 2 tokens. Some would say there's 3 if you count the native token or stablecoin Honey. We've always said that 3 tokens is better than 1, but really it comes down to 2. There's Bera, which is the gas and or staking token of the network, and then there is BGT, which is the rewards token of the network and is used for governance. It's incredibly important to note that BGT is entirely illiquid and soul-bound and can only be earned or produced once the chain is live, as validators produce block rewards. So perhaps the best way to think about this is a little bit of like a waterfall of sorts, in that we start with the validators at the top or at the bottom, depending on how you want to look at it.
You want on the top or the bottom?
Let's say top. Let's say top.
Okay.
So validators. There's a set on Berachain. We use Comet BFT/Tendermint under the hood, so a single slot finality. But that also means that we are somewhat limited in that set size. So Berachain will be able to support up to 256 validators. The important thing to now know is that the logic for validators and block rewards is effectively, it's not quite 2-tiered staking, but there are 2 elements to staking in that each validator must both have a Bera stake and a BGT delegation. So a validator may have anywhere between X and Y. So let's say, what we're looking at right now is 250K and 2.5 million Bera staked with it. And that is effectively what dictates how often it produces blocks. So this is somewhat similar to what max EB will look like on Ethereum in the future. And then on the other hand, you have a BGT delegation. And that BGT delegation is what anyone can delegate to a validator, same way anyone can stake to a validator. And that is actually what determines the size of the block reward when a validator wins a block.
Quick question. So 256 validators. Every validator can only stake something within this threshold.
Correct.
Their stake weight, their money at risk determines how often they produce blocks?
Correct. Or if they run sort of like staking pools, whatever it might be, delegations.
So delegations also affected?
Yes, delegations also. As in Bera delegations, right?
Yeah. So their own stake, delegated stake. This is what comes up to like how
often you propose a block.
Blocks are produced, and
You
then
got it.
BGT what happens.
Then you got it. So BGT is then what determines how big that block reward is when a validator wins a block. I won't go into the formula itself because it's a little bit like involved, but the way to think about it is that there is some base rate or some minimum amount of BGT that a validator will produce every time a block is produced. And based on the amount of BGT that is delegated towards it, a validator will have a larger block reward. Now, there are some effectively, the best way to think about it is there's dampening functions of sorts on this because you don't want a validator to, just snowball incredibly hard and then have the majority of the BGT on the network. You want that to taper off a little bit at some point. But the most simple way of thinking about this is that Bera is for block proposals and frequency. BGT is for size of reward. Bueno?
And I only get BGT by producing blocks?
Correct. The only way that BGT is introduced into Berachain or into the network is by block production.
So wait, why won't it spiral?
I mean, well, it could, but the more important thing is that you actually need to have like a pretty tight set of boundaries on how that can not spiral, in terms of like limiting the point at which it becomes EV positive to add more BGT to a validator.
Okay, so I want to make sure. This is frequency here. You're 250K to 2.5.
Yep.
And then you have some function, BGT, actually. So there's 2 rewards, technically. You're getting Bera, that's the block reward, right?
Well, no, all the block rewards are in the form of BGT.
Every block reward's in BGT.
Every block reward.
So BGT is also the input and the output.
Correct.
Okay. Interesting.
Yeah.
Okay, BGT is a determining factor of how much BGT you get. And then now explain how this trickles down, because this is like the most interesting part.
You got it. So each validator has what you could call a cutting board, a pie chart, whatever you want to call it. It's effectively their ability to choose where that block reward is distributed, right? So the way to think about this in my mind is like it's as if each validator has its own curve gauge, such that when it produces a block, it gets to say, okay, I'm going to send this amount to pool A on the DEX. I'm going to send this amount to supply side LP on this money market. I'm going to send this amount to this like spicy derivatives project, etc. Right? And that's sort of the first part of proof of liquidity, which is to say that validators can arbitrarily choose where their block rewards might go. What this actually unlocks or opens up and is what is in my opinion most exciting is the ability for validators to actually interact with protocols to support their own liquidity, right? So what you can then have is what we call an incentive marketplace.
All right, hold on one second.
Yeah.
Why do I want the BGT to go to anyone else but me? Why do I want this reward to not just go to me?
I mean, because like it's coded that way. and beyond that, at the end of the day, right, you want the ecosystem to be able to succeed because otherwise the chain spirals into nothingness, in my opinion. Right? I think we've seen a number of ghost chains where a validator set, harvests the majority of the rewards of that ecosystem, and that chain itself kind of flounders. As in, the value capture is actually going to the, stakers, which is nice in a manner, but is entirely avoidant of the application layer, which is really where, in my opinion, the majority of value and user acquisition opportunities accrue.
So the validator must be altruistic? I mean, there's also this incentive market you're about to describe. But they don't need to be purely altruistic, right?
Correct.
All right,
Well, but the thing is,
Sorry.
a validator can also be like quite mercenary or capitalistic in this incentive marketplace. Because what this effectively does is it opens up the ability for a validator to exchange a portion of its BGT emissions or effectively to lock in a deal and say, hey, in exchange for you giving me and my delegates X amount of your protocol token, whatever that might be, or it could be a portion of fees, it could really be anything that they choose to denominate in, I will direct Y amount of block rewards towards you. So what you're really hoping for as a protocol here is you're hoping to be able to say, okay, I'm going to give up, let's say 90 cents worth of my token, and in exchange, I'm going to get $1 or $2 or whatever it is worth of liquidity, right? And I'm going to ultimately earn more in terms of increasing the depth of liquidity on my pair. I'm going to earn more in trading fees. I'm going to make my protocol more accessible for people to use from this marketplace. And as a validator, you can take a couple of different approaches. You can choose to incentivize the most, vanilla, stable pools possible that would probably have very light incentives, if any, or you can take more of like a venture style portfolio and work to support a whole bunch of like early stage assets, shitcoins, whatever it might be, these like, groups that are sort of in that start of their growth phase and hope that they, accrue massive value over time and you're one of the first people to actually get that token exposure.
In the rewards that are going out, all right. The pools bribe the validators, get the validators to say, I'm going to give you some of my block reward.
Mm-hmm. So the way to think about it is that there can be incentives placed on the pool.
Yep.
In most cases, you'd expect that to come up from a protocol, but that could also come from like anyone. It could come from a whale, for example, who said, hey, I've got a ton in this stable pool, and maybe if I bribe a little bit more over here, I'll be able to boost my yield to be more valuable than the cost of my incentive that I put up, right? And then the validator can choose to accept or not accept that offer effectively. So that's why they have, quite a bit of choice. But
what's going to those pools is BGT again?
Correct,
or is
correct.
Yeah,
It's
it's
BGT
BGT.
again.
Always BGT.
So it's always BGT that's getting emitted and flown around, and validators in turn are in turn able to earn, of course, some portion of BGT from producing blocks and a set of incentives from the protocols building on the chain.
All right. Protocols bribe validators. Validators mine blocks. Block rewards distributed back to protocols in some form, however they decide it.
You've got it. And I think the most important part of this entire equation is that, in each case, it's rewarding liquidity provision or a given action being taken on chain, right? So at the end of the day, that BGT is flowing through to protocols, from validators to protocols to the users who are actually LPing in them, hence the idea of proof of liquidity. And I'd say it becomes a little bit more abstract and interesting when you consider that technically any given stakeable token on the network can become part of proof of liquidity or can be an eligible destination for BGT rewards, right? So, of course, the most clear use case, I think, as we've seen, is in DeFi. Certainly interesting in terms of activation energy for certain derivatives products. Very interesting when it comes to BTC DeFi, which is hunting for different yield sources on chain and trying to find a way to get off the ground a little bit more. But it also becomes kind of interesting when it comes to incentive design for some of these more user-facing or consumer crypto-style applications. Because you could have someone effectively build a version of, I think on-chain questing is a shitty way of putting it, but effectively a way of incentivizing a set of actions that may be intermittent, that may be based on a certain amount of volume going through a protocol, that may be based on a certain amount of trading fees being generated by a user that gives them a stakeable token that could then plug into this entire equation.
All right, couple more questions. Why does a user want BGT? A user wants it because...
User wants BGT because as they delegate to different validators and they delegate that BGT, they're able to earn a share of all those incentives that the validators are getting from different protocols on the chain. Right? And, the most perhaps important part of this equation is that at any point in time, a user may one-way burn their BGT into Bera. They can really choose to stay illiquid per se and have an influence on governance in the chain to effectively influence which pools are getting more emissions, perhaps boost their own yields. So a very reasonable strategy that a user might take is, okay, delegate their BGT, or earn a bunch of BGT by LPing in a stable pool, or a volatile one for that matter, and then take that BGT and delegate it to a validator that's pushing all or the majority of their block rewards whenever they propose a block towards that pool. That way they can effectively help auto-compound their own yield. Right, so it basically means that users have the choice. They can either take a bet on all the different incentives, the fees that are generated by the system, and the ability to swing yield towards their pools, or they can one-way, nuke it into Bera and then, fuck around with that in the liquid market, LP it in something else, whatever they might wish.
So validators are trapped. Validators are illiquid, gaining power within the system for as long as they keep their BGT, and in some form that's compounded with some dampening effect. Users are also getting participated in this. Every single BGT reward and every element of this goes to somehow incentivizing the system in terms of control. So control, rather than being purely proof of stake within the validators, becomes some sort of proof of liquidity, I guess, across the overall system or somehow. But BGT is distributed across users, across protocols, across validators, which are basically what determines how block rewards are distributed. And then whenever they want, they can basically check out of that system, but it's a one-way door where your BGT is gone, your influence in the system is now zeroed, and you can walk away with whatever the bear is.
You've got it. And the fact is that your ability to earn these incentives and to basically get a cut of like all these different things happening on the chain is gone if you nuke your BGT as well, right? And I think the beyond legal thoughts around the definition of a security, et cetera, and BGT being non-transferable, the more important nuance to get across is like the entire ethos here is that in order for a user to benefit or to be able to really have meaningful say in the future of a system, they actually have to put capital to work, not just buy or sell something, right? Like, it's not necessarily helpful for the ecosystem if someone just buys the Bera token. Like, sure, you can have a long conversation about positive price action and market dynamics and psychology, yada, yada, yada. But moreover, it's about, can you contribute something that actually improves, the user experience, the fee generation, the volume, all of what I would consider as the more fundamental aspects of an on-chain liquidity engine.
Is this just like totally insane to you, by the way? Does this seem
I love
nuts
it.
or do you like, yeah, okay.
I'm bullish Berachain.
Love it.
I know you and Jack have yapped a fair bit about this already, so he's the most POL build guy I know, and I love him to death for that.
All right, let me see. I had a couple other questions written down. I got two into being a scribe here.
Thank you, Brian.
Second. Where did this go?
So how about those bikes?
And most around the same. We went through how everything works. Actually, you guys, listen. You two are two of the most on-demand people in the entire industry. Somebody better ask a question this time. So let's do that instead. You guys have two pretty incredible people to ask DeFi and insanity questions related to. Who's got one?
So would that 256 validator, like how are you going to curate that validator set?
Yeah, there's a few different elements, man. On one hand, part of it will involve, I'd say, a number of the groups have been doing work on our testnet for the better part of the last year or so. There's some protocols that are going to be trying to run their own validators as well. And in most cases, these are groups that have just really been putting in the work for extended periods of time. And the number one criteria in our mind is the groups that have actually demonstrated the ability to solidly run nodes. And I'd say contribute beyond the norm, right? Once the mainnet is up, right, it'll be permissionless. If you collect enough Bera, you can spin up a node, and we hope that goes well. But we think a lot from the delegation side about ensuring that these are folks who have really demonstrated the ability to A, engage in proof of liquidity and actually test it out and mess around with it on testnet, and B, to maintain their consensus and execution uptimes very well.
Is it purely the top 256?
It is. So basically, if you are the 257th, like so if you get bumped out of the set, then basically your Bera is just withdrawn to your staking address, and try again next time.
Delegation and actual.
Exactly.
Oh, sorry. Oh.
Hello. If I heard correctly, BGT is soul-bound token, right? So how exactly it happens that you are able to give it to pools and user is able to acquire BGT and able to even delegate it to validators, right? And another is, what is the sync for Bera here? Like, given the function is one way, you go from BGT to Bera, what is the sentiment behind holding Bera for the users, or what's the utility?
So first part, I think I'm using the word soulbound perhaps a little bit liberally here, in that simply BGT is non-transferable, right? As in the validator set can emit it to protocols, and protocols can emit it to users, and there's a very, I'd say, structured reward distributor function that allows that BGT to flow from a validator to the protocol that is delegated, or that is, it is effectively allocated to that user in a pool. But beyond that, you can't trade BGT with the guy beside you. Is the end point, and there can't be a liquid market for it directly. I'm sure there's going to be people who try to play spicy OTC games as they may have had in the past and sell wallets with BGT, yada yada yada. But like those are things that we cannot necessarily control for. It's more about attempting to enforce that behavior. On the other side, I think I'll give you the black pill take on Bera. I think on one hand, you could look at it as a proxy for the value of BGT because they will, inherently be quite linked, right? And BGT is, to my knowledge and to my understanding, the first token within an L1 landscape that actually accrues value in some manner over time, whether that be from some of the fees of the primitives in the system, or whether that be from the applications and the incentives that are actually going towards BGT holders through those validators, right? And then the other incredible black pill is that I don't think that anyone values L1 tokens on fundamentals, and I think that is the most mid-curve take possible. You can say that there's staking rewards and that staking is where that goes, but apart from ETH, I don't think there are any L1s that have been valued on fundamentals in a very long time, and I don't think that we are going to necessarily see many of them in the near future. The sad part of it, but I think it's kind of the rub, is that L1 tokens have always been a tool for speculation on the ecosystem that they possess. And I don't think that people say that quiet part out loud too much, but I tend to believe it to a point. That's not to say that I don't believe that there's lots of different sinks within the system for Bera, whether that is core pools on a DEX, whether that is positions in a lending market, whether that's sort of liquid staking derivatives that will exist. But what is the use case for SWE, bro? I don't know. It's at 33 billion, I guess.
Thank you.
So you've got two market situations then. I think one of the things you said before was the idea is that by having bribe markets going from apps to validators, you're having this dynamic where you're still trying to get incentives back into the chain. But now the validators are sitting in the middle getting bribed. So presumably there's two market types, and that's when the incentives flow between just below one to just above one. So maybe could you speak about what would cause market structures to go between those two cases? And I'm thinking of like, you see that in bribe markets all the time. And do you think that there's any sort of spirals that you have to be wary of in that situation or not? Like, I'm just interested.
I think that in a perfect world, and some of the things that we're looking at over time, you have almost like a little bit more of a responsive system in terms of even BGT to Bera redemption rates, right? Such that as, for example, the value of those incentives go down, one would increase the incentive or the staking rate on Bera, such that there is more incentive to, hold that token and to bring it back into balance per se. But I think one of the interesting things we've seen with bribe mechanisms, even in like the tiniest of protocols, is that if there is value to be gained or extracted, someone is bribing at the tiniest pools with $30 in them. And you're smiling, so it strikes me as you may have seen this before, right? So in terms of those two states, I can't say I necessarily worry about that a ton. I think the spiral, if you will, is a lack of volume or a lack of activity. As in the spiral comes from stagnation, right? But if it is constantly trading in a manner where, a bribe is being issued for, 70 cents worth of, like $1 is going for 70 cents or $1 is going for 50 cents, et cetera, I think that's really more of a macro sentiment than it is necessarily a efficiency of that given bribe market sentiment. But I do believe that over time, a more responsive Bera BGT conversion rate could get more interesting there. But I think part of it is also that simply we have a lot of moving parts in the system, and erring towards some degree of simplicity, even from an education point of view to start, might be a little bit more helpful. And as we see that actually, going live, it's very possible to have, more quantitative adjustments via governance over time.
So is that going to be potentially controlled by, because this is the only time I've seen it's being done at the protocol level,
Yes.
which is super interesting. Gets rid of your liquid lockers. So this will happen. Are you then going to control these emissions dynamically, or is that something that can be set, upgraded? What's your thoughts on that?
And sorry, when you say control the emissions, do you mean the inflation rate, or do you mean
Exactly. Yeah.
Yeah, that is one that will be set by governance and will effectively have a target at chain launch, but we expect that to become a little bit more dynamic over time.
Cool. Thanks.
We've got about 7 minutes left, so I just want to make sure we get at least a couple.
Okay, so the base model view is the get validator and the actual protocol are closer and to interact with each other. But will not it create more MEV stuff and over-the-counter deals because it can be like deals between the protocol and the validator, and it can be settled over the counter. So it's kind of like a threat or maybe some mafia that could be possible. And also it could result in a more MEV stuff because you need a lot. You will have a pretty direct link from protocol to the actual validator. So will you be doing something with that to be transparent and more open?
Yeah, I mean, all of this will be able to be, viewed on chain, right? So one will be able to say, okay, a validators are in this many blocks, this is where it's going. And if one sees a validator, delegating to a given protocol with very little to no incentives, I don't think that'll be too difficult to identify. I think it's impossible to entirely avoid the existence of these OTC markets, but I think that whether that be through curation of a, well-known and a generally altruistic validator set, or whether that simply be from actually building these marketplaces so that it's much more convenient to go through that process, where the protocol itself isn't really taking a cut, right? Berachain is not extracting value from that process; it's going towards BGT, which the validators are still incentivized in, right? So I think my TLDR is that I believe that your case is valid and it could very much exist, but I do believe that there's also a lot that can be done from the social and or social consensus side to mitigate that beyond the tech stack that's been built. But by no means a perfect solution, and that's something that we'd love to be able to tighten more and more over time. It's also one where if there's enough incentive to bypass the system, most people always tend to find a way. So we hope that doesn't become too much of a thing. And in terms of the MEV side, completely agree. There are some anti-MEV solutions that we'll be working with, but I think, again, most of these are halfway solutions as opposed to real end problems, right? And that's just being pragmatic about it.
Yeah. Thanks.
Anybody else? Come on, you have a chance to ask these guys questions that often. Not a single one.
I wanted to understand a little bit more about how exactly the yields flow into Sky and Spark, because my understanding is it's related to T-bills in some way, but there's also a whole lot of other things going on. So you touched on DIV1, and I'd really like to know a little bit more about what actually the flows on the current protocol are, and
Yeah, sure. I mean, this is a really important question. Yields, you can put up a big yield number and people are like, oh, great, but it's super important where it's coming from to measure how sustainable and safe it is. So yeah, over the years, DAI, now USDS, has evolved. Originally, all the revenue coming in was from crypto-native loans. This still is actually the largest revenue earner for USDS to date. But as the interest rates have gone up since 2022, having all this USDC on the balance sheet was quickly rotated into direct treasury bill exposure because the USDT, USDC, the Circle, Tether, the issuer keeps all the yield, so they do not forward it. And actually, I find as from a morality kind of thing, I believe that any stablecoin should be forwarding the risk-free rate to the users by default. So this is just a personal belief I have. So right now the balance sheet looks like approximately split between RWA exposure, and this is through specifically T-bills, and crypto-native leverage. More recently, we've been able to gain access to centralized exchange perps via Athena. So there are now there's 400 million, going to go up to 650 million soon in exposure through more faux vaults that people have levered up with Athena's USDE and SUSDE, which then captures the perpetuals yield on centralized exchanges, which this is access to the broader retail ecosystem. This is mostly what users are using to lever up on Bitcoin, ETH, and Sol. So yeah, that has been a big money earner. So like these perps rates, like sometimes 3 days ago, they spiked to like 80%. It's nuts. So yeah, Sky is able to capture a lot of this yield by basically just buying SUSDE and holding it on its own balance sheet, which then it goes through these layers of de-risking. There is a $60 million surplus buffer. This is an insurance to ensure that USDS holders, as a stable coin, are the most senior in this position. So you have the 60 million insurance buffer. You have 120 million in protocol and liquidity between USDS and the Sky token, formerly Maker. And these levels of insurance, so we're not providing the same APY as Athena, but it is de-risked quite heavily. And the other advantage that USDS provides is this massive amount of stablecoin liquidity. So USDS is the largest single holder of USDC on Ethereum mainnet. I mean, the exchanges are larger, but they split them out into multiple wallets. And so this is all available in what's called the PEG stability module, which allows for one-to-one swaps between USDS and USDC. And there's always a target reserve here of 25%, so that basically you can think about USDS as earning this relatively safe yield that's capturing the broad spectrum of opportunities that are available in TradFi, DeFi, and CeFi. But also you have this huge amount of liquidity. It's over $1 billion. So you can even exit 600 million USDS into USDC. If you can do that today, you can go do a payment with that. And this is what we're striving for as a stable coin that's more in this middle ground. And so far, revenues are actually at steady state all-time highs. It's just been continuing to be optimized over the years, capturing more of the T-bill balance. And the work that we're doing at Spark is continuing to optimize this balance sheet such that we'll be mostly in T-bills when it's a bear market and everything's the rates aren't that high in DeFi. But then we'll be able to very rapidly rotate into products like Athena, where we can capture the perps yields.